In this video, we're going to be going over the hidden power of SCHD and why it's more than just dividends. So, as we all know and love, SCHD is probably one of the most popular dividend-focused ETFs, very low expense ratio of 0.06%. The objective is very clear. It's to track as closely as possible, before fees and expenses, the total return of the Dow Jones U.S. 100 index. And it's a very straightforward, low-cost fund offering potential tax efficiency, and it serves as a part of the core in a diversified portfolio. So it tracks an index focused on the quality and sustainability of dividends, invests in stocks selected for fundamental strength relative to their peers based on financial ratios. And part of what makes this ETF so successful is its annual reconstitution, where it rebalances its portfolio, it kicks out the underperforming stocks, and it adds in high quality dividend paying stocks. So it's always updating with the latest and greatest in its portfolio. Now, if you take a look at the dividend yield, it has a pretty low dividend yield. Usually it's between 3.5 and 4%. And in the high income, high yield dividend investing community, this is very low. But as a growth and dividend focused investor, this is one of the best ETFs as it provides a nice balance. And we're going to see that over the long term, since this fund was created in October of 2011, it has a total return of just over 200%. And this is on share price alone. With dividend-focused ETFs, we don't really see this type of growth. So it's very nice that we're getting that share price appreciation. We can rely that this ETF is not going to have any severe NAV erosion like a lot of the high-income yield max ETFs. This is a very stable, very quality ETF. Now, if we go to the dividend channel and we calculate our DRIP returns calculator, because as we mentioned earlier, this is the total return without dividends. So if we head back to the dividend channel and we chart $10,000 invested, we can actually see that we have a total return closer to 363%. That's 160% more than if without any dividends. And this is with dividends reinvested, assuming you have dividend reinvestment plan turned on, reinvesting your dividends back into the fund, making that compound interest grow even further. So our $10,000 starting balance is going to end with $46,000. That's an insane return, and it's a happy, pretty good return compared to the S&P 500 and a lot of those other dividend stocks, such as Coca-Cola. You're going to see a much higher return with this ETF. Now, even if you don't reinvest those dividends, say you're using those dividends for expenses, you're going to withdraw it, or you're just going to reallocate those dividends to other funds without dividends reinvested, you're going to have a total return just under 300%. Now, that is significantly higher still compared to the 200 total return share price appreciation of SCHD. Your $10,000 starting balance is going to have an ending balance just under $40,000. This is an insane return, and it's why power of SCHD, why it's more than just dividends. You're getting a share price appreciation as well as growing your portfolio with those dividends. And the best thing about SCHD is it's always growing its dividend. It has a dividend growth rate of about 16%. Currently, the dividend yield is under 4%, and it's paid out quarterly. And it's paid out quarterly. You're not really receiving a huge amount of dividends, so a quarterly payout is just as fine because it's reliable, it's always growing, and that's really what you want to see in a dividend-focused ETF. Now, if we take a look at the 10-year chart for the dividends, we can see it's pretty much going up and to the right, which is what we want to see. And currently, we're getting about 25 cents per share that we own. So if we own, say, 100 shares of this ETF, you're going to get pretty much one share every single quarter. Reinvest that back into the ETF, let that compound interest grow, and you're going to be really happy in the long term. Now, this ETF does have many awesome holdings. As we can see, some of the top holdings are going to be ConocoPhillips, which was recently added to this ETF. We have, of course, Coca-Cola Company, a very staple dividend stock, Verizon, Lockheed Martin, Altria Group, Home Depot, AbbVie. So we have a lot of dividend paying stocks, very high quality, and The best thing about this ETF is it has a lot of dividend growers. A lot of these stocks in this ETF have been growing their dividends over the long term. So we know this is a very stable ETF. We know it's going to grow over the long term, and it's going to help a lot of investors increase their portfolio balance. And as you mentioned earlier, it has actually outperformed the S&P as of recently because it's been so stable. With a dividend-focused ETF, you're going to have stability because the volatility is not really going to be there. As we see in the holdings, these stocks, Coca-Cola, they're not going to drop that much in a recession, which we probably currently are, compared to a lot of the tech stocks, which the S&P 500 consists of a lot of, such as Apple, Microsoft, Meta, Google. All of those are very volatile tech stocks, and we do not have them in this ETF. We have very stable companies. So if you're looking for something that's a little bit more recession proof, SCHD is a great option because not only are you getting a stable stock price, but you're getting payouts every single quarter, and that is going to always continue to grow.